All right. So yeah, thanks for coming. I know it's a Friday, so guess there's a bit more extra effort to cover the Friday evening lesson. But at least it's online, so hopefully at the comfort of your own home. So yeah, let's start. So just like to this course, I want to do a quick maybe show of hands, okay, or maybe just a comment. Are any of you all from like year one? Because this is a level three kind of module. Anyone from year one, or are most of your um year twos or year threes here? Year two, year four, okay, year three. Okay, okay. So, okay, that's good. See a good mix of year four, year two, year three. Yeah, as the course suggests, so we do need or you do need some knowledge on things like time value of money, uh, compounding, etc., which are typically covered in the year one modules. Which is good that none of you are from year one. If not, you might find it a bit tough. Um, are there are there any exchange students here? Because I think there might be one or two, or maybe no. Okay, maybe no. Local exchange. Okay. Uh, okay. Oh, I can see one of you are from NTU. Yeah. So welcome to this module. So maybe I'll just share. So for this module, we have two lecturers, myself and Patrick. So for me, actually, I'm teaching two classes for this module. So am teaching the Thursday lesson as well, which is yesterday in the evening, in a physical format. Um, and of course the Friday evening lessons on Zoom. So I open up to my other class as well, my Thursday class. So if any of you all have any clash, conflict, because I know there's a handful of part-time students who are actually working, or even full-time students who are doing internship. Do let me know if you need to do like a ad hoc switch. Of course, we try not to do too many switches, but if you really need to, let me know. At the end of the day, all lectures are recorded. So just in case you want to attend the physical one, maybe you have some more questions you want to ask, feel free to let me know. Then I'll take note that you are going to join either the Thursday lesson instead of the Friday one. Just to note that and I'll give you all the details for Thursday one if you would like to join that one for one lesson, right? Because of certain clash in your schedule. That one is physical, so you have to be present in class in SUSS, right? Okay. Maybe just a little about myself before we run through the module. Um, Bit of my background. So I did quite a few different career. So I did my undergraduate in accounting, and you'll realize that in this particular module, a strong foundation of accounting is quite important. So started in accounting. As I did do accounting, but I studied accounting. Then later I did my master in finance. Went into industry, so started my career as a credit risk analyst at Credit Agricole. So Credit Agricole is like a French bank. Normally it's between Credit Agricole and BNP competing for who is the largest French bank in France, and depending on the different metrics, AUM or share price, etc., they usually fluctuate, right? So some years Credit Agricole is the top, some years BNP is top. Then after that, I did. Then I went into more corporate banking. So I was a ARM, so assistant relationship manager, and eventually became a relationship manager managing corporate portfolios. After that, I see somebody is doing credit and as an analyst as well. That's cool. Are you in a bank? Right. Okay, so while you type, continue my story. So then after that, I decided to do a switch, or not really switch, but a career pause. So I actually went to do my PhD in Canada. I was in McGill, in Montreal. Um, I wanted to do sustainability, so focusing on ESG, ESG finance. Um, I did it for a year and a half. So and then I kind of realized that actually research is not really my thing. So I did the coursework. Coursework is probably like what we're doing now, like lessons, exams, um, assignments, projects, etc. Then I realized that I really dislike research. I felt that there was very little impact in the society. Of course, not saying that if you shouldn't do research, but research is important because you find new knowledge. But I realized it wasn't a cup of tea. So I actually paused or decided to stop my PhD. Um, and then I went into data analytics because as you might suspect, when you do a PhD, kind of really focuses on programming, AI, all the cutting edge kind of like stuff, right? So you do like Python programming, you train machine learning models, etc. So I actually did kind of analytics for about a year at BNP in Canada. And then after that, I realized that, hey, you know what? I didn't really like analytics so much. It's fun, it's cutting edge, but it wasn't my cup of tea because I felt that I was so far away from the business, right? So some of y'all, I understand already working, you know that if you are at the front line kind of role, you're really interacting with clients, right? Unlike if you are, let's say, building a data model at the back, you probably only receive the information, the data from the front end. And so I felt it was so far away from being in the front line. So I decided that I was not too interested, kind of went back into corporate banking. So went back as an RM, now in a Middle Eastern bank. And then um, currently I got opportunity to return back to credit and recall again. And now what I do is credit approvals, right? So I think I see there's like at least one person who is a credit analyst. So analyst is there are a few levels. So at certain level, you are the one actually approving the credit. So I decided to pivot into that role at the moment. So you see that my career kind of a bit more dynamic than your typical maybe if you join the corporate world and stay in that role for or role or type of role for the like last 5, 10 years, kind of did quite a big transition, right? I always like to share so my story that sometimes it's okay to take a bit of detour, right? To figure what you really like. And an example I always share is like my PhD, where initially I really thought I would enjoy the kind of rigor of research, but and there's no kind of shame in dropping out and realizing that it's not your cup of tea. Yeah. So yeah, hopefully you might learn something more than just this course in my lesson. That's like maybe a life lesson along the way that you will take on for the rest of your school career and your professional career as well. Right. So of course, if anyone is interested in banking, want to find out more about corporate banking, um, type of jobs, type of roles, do feel free to drop me an email. My email is here. Always happy to, kind of see how I can connect you, and try to explain how the industry is like. Uh, okay, I see someone did a credit analysis at ESG internship. That's great. Uh, yeah, internships are quite important as well for you to land your first job, right? So really good. Very encourage you to do as many internships as possible. Right. Okay. We do have some course materials, study guide and textbook. Generally, I would just say focus on the lecture notes. and they are good enough for all your assignments, your project work, and even your final exam, right? Or your final assignment. Because you know that there's not really an exam at the end, it's just a take-home assignment. So it's good enough to just focus on the lecture notes, right? And of course, if you have any questions or you do have any doubts, you can look at the study guide for more information or the textbook. But if not, you can reach out to me as well, right? Normally, I reply emails very quickly. Maybe it's part of my job. I'm a bit addicted to my emails, my Outlook. So you will find a rather quick reply if you do have any questions. Um, in terms of assignments, we have the class test for this. So the class test, there's the full list of information is already published on the lecture site. So do have a look at it. Basically, it's going to cover Unit 1 and Unit 2. Basically, today's lecture and the next lecture. Group-based assignment. Today, one of our agenda is to form groups of 4. So 4 or 5, let's say you have a group of 5, you can email them to me, or group of 4, email them to me by the end of today's lesson. However, if you do not have any grouping, do not worry, I'll just randomly assign you to a group, right? In case you only have a group of 3 or 2, do still email me, and then I'll see what I can do to try to slot maybe two more persons to form you into a group of 4, right? I also want to let you know that in case there's like one person that, let's say, doesn't have a group, right? And then all of you all have already formed groups of 4, I might actually put that person in your group. So I'll just let you know, and then you'll find additional person in your group, right? I hope that's okay with all of you. So at the end of the day, you guys can form your own groups. Simply drop me an email before the end of today's lesson, and then I'll do a formal announcement on your grouping after that. Okay. Class part. So normally I get asked this quite a bit. For me, I think there are some students who have taken my previous courses before, and you probably know that for me, class part is quite I like to be very transparent on how you score on class part, right? So everyone, regardless of whether you attend lectures or you don't, would get 50%, which is 5% of your class part marks. And as you know, especially for those who are SUSS students or year 3, year 4, you know that for evening lessons, um, being present or attending the lessons are not mandatory. Basically, you can watch the recording and that's all right, which is why everyone will get 50% of the class participation. Now, for the other 50%, which is the other 5% of the grades, that one would be really just based on your participation in class. Whether it's you have to ask questions, maybe or to even make a comment. I think the Zoom format is a lot easier because you can just type. Unlike the physical class, I typically see a bit more quieter and less response because of course you have to read you got to speak up and also generally less quiet. So I really encourage you, since this is a Zoom format, to just you can either be replying in a group chat, or simply unmute yourself, right? Either way is fine. And if you do have a questions, who knows, right? Maybe your other classmate might have the same question as well. So just do not hesitate, write drop a comment, maybe even type your message if you do have some. Right. The last component, your ECA. So your ECA is a take-home kind of project, and basically it covers all the topics. And you'll see that in this module, the focus is really on one thing, right? Throughout the entire module, you're just going to cover one key topic, and the key topic is how are you going to value a company? And when we talk about valuing a company, we're thinking about using fundamental analysis, right? Really going into the details of the company and try to understand what is the valuation of the company. And through that, try to write a report, try to recommend whether you should invest or not invest in this company, right? So that's the purpose of this entire module. So along the way, there are 6 lectures. You will learn basically various tools to value a company. So we will teach as many tools as we can load you with in a sense, but remember that when valuing a company, you need not be using all the tools, right? So we'll cover a lot of tools as we will go through in a bit, but you need not be using all of them. In terms of financial calculator Excel, this is a valuation module, so financial calculator is kind of not good enough because you need to do your uh, discounted cash flow models, etc., which you need the Excel to do, right? So we'll not be using financial calculators. And yeah, so today's module, I'd like to give you just a broad overview on what we're going to cover. Is more on the qualitative aspect of valuation, right? So in a typical valuation, the qualitative aspect would cover, I would say, 40%, maybe 35 to 40% of your report, right? So the qualitative component of your valuation is quite important, right? And we are only going to use one lecture today to cover these 35 to 40% of your report. So I encourage you to, if you do have any questions, to, type them in the chat, because say it's easy to overlook. It's easy to, if you are doing an assignment, to lose marks in the qualitative aspect compared to a quantitative aspect. Because the quantitative aspect is, as long as you follow the formulas, as long as you follow the process of doing the valuation, you are kind of safe. It's more on the qualitative that can be quite broad. It can be quite you need to be very careful when crafting your qualitative argument and explanation. Okay, I'll just pause here for a short while. Do you have any questions regarding the assignments, groupings, I don't know, financial calculators, or anything relating to the module? All good? Okay, right. Um, That's a good question. Not sure. I've not really looked at the announcement on class test. I believe is the comment was just that you have to do it on your own, right? And not as a group. But I'm not sure, and I think of course it's online. So I'm not sure whether there is a room allocated for your class test. Um, Anyone know? If not, I can actually just double check for you with the course coordinator the lecture. So the class test is you can take it home by yourself, right? So let me just quickly go into the announcement. There was an announcement made on the lecture site. So this one, encourage you to have a look at this. There's quite a bit of information here. The class test, so which period would this be? So it's on a Saturday, 28th of March, from this period to this period. Yeah, have a look through at this. There's no room allocated, so you can do it at home. You need not be doing it in school. But there's some comment that you should not do it on your mobile phone. Try to use a laptop. Um, which period would the class have? Okay, so I hope I answered that question. So it's on the 28th, right? So it's not a date range. Okay, right. Okay, so let's jump into valuation, right? So we're going to the module proper. Um, so how I usually like to structure the lesson is that for things that are a bit more general, things that you can just read through yourself, I typically go a bit faster, right? So you will see that only on aspect of key important theories or concepts that you need to know, I will try to spend a bit more time on them. But if I go faster in certain areas, do know that they are less important, or basically they're just more descriptive kind of slides, right? So not really key slides. Okay. Also, I would like to usually have two breaks. So every hour we try to have 8 to 10 minute count break, so that we can whether go to the toilet, or just have refresh yourself a bit, because it can be a bit heavy at times. So usually that's how I like to structure 3 hours lecture, right? Okay. So in terms of valuation, um, the the broad idea of valuation is quite simple, right? Any asset, whether it's financial asset, physical asset, has some kind of value, right? Some kind of real value, can call it intrinsic value, right? And the idea of valuation is to try to determine what is this real value of the asset. And of course, given that we're in a finance module, we are trying to determine the financial value of a financial asset, right? So in this module, we'll focus 100% on stocks. So we're not going to cover things like bonds, derivatives, which are a separate module. So we're going to focus on stocks. And valuation is important, right? Valuation is covers various roles, things like merger acquisition, portfolio management, corporate financial management. So this includes things like I think you have one of your friend is a credit analyst as well. So when you do credit analysis, it's part of valuation. Even though you might not do the full, recommendation of undervalue, overvalue kind of role, but in some aspect, when you need to kind of approve certain kind of credit limits, the process of valuation is kind of the same, right? You start off with the sector, the financial statement, etc., right? So at the end of the day, what I'm trying to say here is that valuation can bleed into many parts of finance. You might not be a merger acquisition analyst, M&A analyst. You might not be that, but you might still find this module, or the information you learn through this module important, right? Also, it could be even for your own personal investment thesis, right? So determining which company to invest in. So that can be applied to valuation, can be applied to that as well. So how do we value something, right? The simplest way is to find asset that is similar, right? And in this sense, if we have two companies and both of them have similar business, and if we have the value of one company, we can determine the value of the other company. Now, by doing so, yes, we have a comparison, but we need to understand also that valuation introduces personal biases into the value of your asset. So what I'm trying to say here is that because valuation comes from a state of personal opinion, maybe your perception of the market or how the company will perform. There's a bit, or not a bit, but there's a substantial portion of judgment that has to be put in place in order to value a company, a stock, which is why it is definitely not an objective kind of exercise. It is um, non-objective, but at the same time, we try to use various tools, and in this lecture, qualitative tools to guide us to the right valuation. So we are trying to find the true value of the financial asset, um, and and hopefully we can kind of go close to the intrinsic value of the company, right? Okay, so we have a small little component here where we try to understand, is the market value the same as the intrinsic value, right? We have two kind of things, intrinsic value and market value. Have anyone heard of this efficient market hypothesis? And I know it's probably in the next few slides, but in your own words, what does this efficient market hypothesis means? Anyone can either unmute yourself or type them in the group chat or type answer there. Market perception, uh, not really. Good try, but not really. So efficient market hypothesis. Okay, you are there, yeah. The price of asset reflects available information. Yeah, that's good. So it's something about information, right? Basically what's the difference between the intrinsic value and the market price, right? Just based on new information, no information asymmetry. Okay, we are there, right? So it's about information, it's about price. So basically, what efficient market hypothesis is trying to say is that generally stocks are at equilibrium, they're fairly priced, and there's no so-called information asymmetry like what your friend mentioned, because the information is all very efficient. Everyone gets the information, whether it's public or private, and so it is incorporated into the price of the stock, right? But with that said, the efficient market hypothesis doesn't say that you cannot earn returns because information has been included already. It doesn't say that. It means that based on all the information available, right, you can earn the returns on that particular stock based on the risk profile of the company, right? So if you take on a company with higher risk, chances are you're going to get higher returns. However, because they incorporate all the information that's available, you can kind of only earn the market level of returns and not anything more than that. However, we know that information on the market is not fully efficient, right? And so in a case of a fully efficient market, let's say we have new information, the stock price should just shoot up like this. So shoot up and level off, right? But we don't see this in the market. And most of the time, when there's new information, the stock price tend to either go up and go down, meaning an overreaction, or a kind of a slow increase, right? So there's kind of a delayed reaction here. Okay. I do see a question. What does efficient market do not imply that investor cannot earn positive return? Okay, so there's a comment here, right? So what does this mean? It means that even though the market is very efficient in this hypothesis, the investors can still earn market returns, but they cannot earn exceptional returns, right? Returns that is higher than the market. Because all the information is available has already been included into the stock price. So what am I trying to say here is that in this efficient market hypothesis, it does not mean you cannot earn a return or positive return in this sense. You can, it's just that the return amount is equals to the market return. Right? Hope I answered that question. Okay. So we know that in the market, the stock price does not go like this, right? It does not go up and level up. There's usually some up and down, or a slow increase. And so this shows us that the market is not fully efficient, which is why there are three kind of market efficiency that we see here. First is the strong form, semi-strong, and weak form, right? And we'll go into some details here. So the strong form basically try to say that, this market, this kind of efficiency includes all the information, which is meaning the perfect case, where it includes all information, regardless of public or private. So everything that's available is included. And this strong form is the perfect efficient market, right? Regardless of kind of information that you possess, it's of no value because the market has already reflected this in the stock price of the company. And so because of this, then you might as well just hold a diversified portfolio. There's no need to hold anything. There's no need to hold an individual stock because the market will have known all the information available, whether public or private, right? But this sounds a bit too utopic, right? It doesn't sound like what's happening in real life in the market now, right? So generally, evidence show that the market is not a strong form, right? There is some kind of inefficiency in the market, which is where we move on to the semi-strong form, where it only includes publicly available information. And this information includes things like reports, press, releases, and so if you are an investor and you only have public information, then you cannot earn any extraordinary returns, right? However, if you do have some private information, this is where you can actually earn extraordinary returns. And because when we do fundamental analysis is based on publicly available information. It means that if the market is in a semi-strong form, then your fundamental analysis would be useless. You will not be able to earn anything more than the market. Okay. Now, the last form is the weak form, where the market only reflects the past market information like stock price, volume, that's available in the market, right? So market information. Now, in this sense, if we do data analysis, which is using charts, looking at the fluctuation or the movement of the stock price, the volume that's being traded, then in a weak form, because the market incorporate most of the past market information, then using technical analysis will not give you good returns or will not give you abnormal returns, right? So based on the empirical evidence, we know that the market is kind of a weak form where they do not incorporate all the information. Maybe they incorporate some past market information. And so if we do some kind of fundamental analysis for the company, which is what we are trying to do in this module, fundamental analysis, you can actually earn some returns that is extraordinary or abnormal returns. Right? Any questions for these three forms of efficiency? Question. So the first form cannot have abnormal returns. Only so the strong form cannot have abnormal returns, only the semi-strong or weak form, right? Because the strong form basically incorporates all the information, so there's no way to get abnormal returns. But in the semi-strong, if you do have private information, yes, you can. And for the weak form, if you do some kind of fundamental analysis, you might be able to find some normally priced stock or undervalued stock, and then you can gain some abnormal returns. That's a good question. So this just to highlight to you, the efficient market hypothesis does not mean you cannot make money, which is, I think, a question your friend asked earlier. What it does mean is that on average, you receive the returns that is equivalent or proportionate to the risk that you've taken. And if you do not diversify your portfolio, this efficient market hypothesis will not protect you from losing or making a drastic loss. So this concept of efficient market hypothesis, will not really be something that you apply in your valuation. It's really more on concept that you have to put at the back of your mind to know that such a theory exists when you do your valuation, right? So we move back to the basic of valuation. having understood this efficient market hypothesis, right? So the idea is that because there is some inefficiency in the markets, then we are now able to do some level of valuation to determine an undervalued stock and make some um, abnormal returns on our investment, right? So the idea of valuation really is premised on the market being inefficient. Okay. So there are just some other comments. Let you read them by yourself. Okay, so this slide, these few slides on the step of valuation will perhaps be the key slides that you refer to in your assignments, whether it's your GBA or your end of course assignment. And because in both cases, the idea of the assignment is to ask you to value a company, right? And perform the full valuation process. In your GBA, you do it as a group, which is like a good starter. But then in your final assessment, it's more of an individual valuation project, right, that you have to do. So in both cases, or in most cases of valuation, you have to go through the various steps, and we'll cover them here, right? So the first step that we look at is first to understand the company's business, right? So really looking at the company, the macro environment, and trying to understand things like the industry, what industry is the company in, what is the size of the company versus its peers, are there any kind of developments, things that are changing in the market that would allow you to assess the company's performance perhaps in the future, right? So really understanding the first steps, understanding the environment where the company is in, understanding kind of demand for its products. In the process, we kind of determine what's the competitive positioning of your selected company, right? Are they kind of a cost leader, differentiation, or kind of a focused company? And last but not least, we determine the competency of your management, right? So a part of valuation will include some qualitative explanation about, are the chairman or maybe the directors, are they skilled? Are they well trained? Do they have a lot of extensive experience in the kind of job that they're supposed to do? And even, who are the shareholders of the company, right? So step one, it's really looking at the environment, looking at the industry, and also the sector maybe the company is in, what kind of competitive positioning the company is in, right? And so in the subsequent slides, what you'll see is that we'll go through various frameworks. And what's important is that we need to use these frameworks that's covered in the subsequent slides to substantiate these few I would say industry sector kind of analysis. So that's a good question, right? Do we have to assess which part of the value chain it sits? Yes, you do have to assess that as well. And you'll see that we'll cover a few frameworks that would allow you to kind of comment on the value chain, which value chain or which part of the chain the company is in, right? Or maybe even which part of the business cycle the company is in, whether they are in like kind of a startup, right? Or are they the growth phase, or maybe they are a mature company, right? So we'll see a few frameworks kind of try to help you craft your argument or craft your idea behind understanding the business of the company. So yeah, we will. Um, and then, so this is the first step, right? Really to use the various frameworks we cover in the subsequent slides to determine, and understand the industry, the sector the company is in. Now, having done that, we typically have two ways of doing things: top-down and bottom-up approach. We'll explain that in a little bit. But we have various approach, right? And then that's where we formally do our industry analysis. We look at the corporate strategy, one of the more important things is do a financial statement analysis. So this is very important. I just put 2 stars here, where we need to form an idea of how the company's financials will be in the future, right? So when you do your project, when you do your valuation, typically we look at the last 5 or 3 to 5 years of past historical financials, right? So I repeat again, normally we look at the past 3 to 5 years of financials, and using these 3 to 5 years of financials, then we can do some forecasting of the sales, earnings, and cash flows, right? In order to derive our quantitative model, right? So that's the step. Usually you look at the past financials, uh, and that's where you do your financial statement analysis. And having done your analysis, you kind of like, okay, you know that you know what, the company is going to grow for 5% for the next 3 years, and then 3% for the last 2 years, right? So you do like a 5 years kind of forecast or projection. So that's typically how you do it. You look at the past financials to provide you some guidance to the future. All right. At the same time, we need to consider things like quality of the earnings. So I do have a question here. Let's say, I have a company, right? And this is actually a live case. So I was looking at this company called Olam. Anyone knows Olam? Olam Group Limited? Have anyone heard before or no? They've never seen this company. No? Okay. So maybe not yet, but okay. So Olam is a commodity, yeah, right? A commodity agriculture, soft commodity trader, all right? So they do have quite a lot of trading revenue, right? They buy and sell things like cocoa, coffee, grain, wheat, soy. They have a lot of things, right? Now, I was looking at the financials of Olam recently, and I noticed that they have quite a substantial FX gains and losses, right? Foreign exchange gains and losses on their income statement. So my question to all of y'all is, if a company has lots of FX gains and losses, what does this tell you about the quality of their earnings? Inconsistent, poor. Okay, very good, very good. You're right. Because instead of their earnings, meaning their net profit being driven by their sales or their maintaining their margins, right? It's actually driven by FX gains and losses from from their movement or their trading activities, right? And so yes, the treasury team must not be actually doing a good job because okay, maybe this year they have a gain, FX gain, but it means that maybe the following year they can have an FX loss. You're right. The performance is very volatile. So yes, when you analyze a company's financials, having this kind of sensitivity to actually where does the net profit comes from, it becomes very important, right? So let's say you do a financial statement analysis, you notice that there's a lot of FX gain and losses, especially for traders, like Olam, they're like trading company. If they have a lot of these FX gain and losses, it's something that you will be worried about. You will be concerned that the quality of their earnings is actually not that good, right? And in a typical sense, if you are doing the valuation of this company, what you do is you actually remove this FX, let's say if the FX gain, you remove the FX gain from their income statement to say that, hey, you know what? Actually, this we should remove it to adjust to reflect the more sustainable kind of income that they are generating for, let's say, FY24 or FY25, depending on which financial year you are assessing, right? So the quality of earnings is an important concept to I'll put another star here, important concept to tackle in your valuation. And typically you do this in your financial statement analysis. Yeah, I like that comment. So it's not purely derived from the core operation of its business. It might be a one-off income. Yeah, totally right. Right. Um, you can see a comment means that our main source of income is that like Singpost. Yeah. So that's a good comment, right? So I think most of y'all know that like Singpost is of course not doing too well. Because who sends letters nowadays, right? Yes, there's a growth of e-commerce, which is why they are trying to pivot towards that direction. But if you do see quite a lot of income that is not quite non-recurring, meaning that it's not the core of their business, then it's really something that you will be concerned on. So normally when there's FX gains and losses, also it could be that the company is big, right? So they do have a lot of subsidiaries and there could be translation FX gains and losses, or not only that, but they are dealing with many currencies and therefore they have such gains and losses, right? But then it also reflects that maybe the treasury department in their or the FX management in that company is not too well, or they are not hedging correctly, right? Which is why they have such large gains. Because unless you are an investment company which try to arbitrage the FX rates to make some profit, then that shouldn't be your core revenue, right? Unless you're an investment company that does arbitrage kind of profit from FX. Um, one last point I want to point out is that in this module, unfortunately, we'll not have time to go through extensively on financial statement analysis. But I want to highlight that this component of the valuation typically holds about 15% of your report, which is quite substantial, right? So it's 15%. So writing a good financial statement analysis would be very important. I do have one slide later to kind of emphasize to you what are the key points to focus on in financial statement analysis, right? And so that will be an important slide. Moving on to step three. Step three is where the next few lectures we're going to cover all these various valuation models. Um, they're all the quantitative models. And what's important to highlight here is to provide assumptions, right? So your model is only as good as assumptions that you have provided to your reader or to the person consuming your report, right? Because like we mentioned earlier, valuation is bias. So what's important for your quantitative component or step three is that you provide the assumptions that you use to derive your figures, right? And we'll go in details in the next, I believe, three lectures on this point. Okay. Role of shareholder ownership in terms of valuation, so control premium. So what does this mean? So when you assess this is a bit more qualitative, right? Or it can be quantitative as well, right? So when you assess a company, knowing the shareholders of this company becomes very important. I like to give you one point, right? So Singapore Technologies. So Singapore Technologies does defense related kind of manufacturing or R&D, right? For Singapore Army, Navy, etc. Right? So they are quite big. Now, Singapore Technologies is interestingly has this special golden share that's owned by the Ministry of Finance. So this golden share basically gave them the veto right, them meaning the Ministry of Finance, the veto rights for any decisions made by the company, right? So it's this very rare thing. I think in Singapore, we only have this one company with this golden share. Now, with this golden share, it means that the Singapore government is actually kind of actively or can actively pivot or change the direction of the company, right? Is a veto right of any resolution passed. So if you understand this, then perhaps you would, not have such a high discount rate, right? For when valuing Singapore Technologies, because we know that the sovereign rating of Singapore is triple A in or Moody's or Fitch, right? Meaning that the risk is very low in any there's a default situation, the Singapore government can actually step in to save Singapore technologies, right? So understanding the shareholder of a company in your valuation report becomes important, right? There are other companies as well. For example, just now we talked about Olam, which is 50, I think it's 52% owned by Temasek. Yes, so I like the comment on Temasek, right? Temasek is also government linked, and so in Olam case, 52% owned by Temasek. This gives us a lot of confidence in terms of um, the parentage of Temasek in Olam. Yeah. So anyone knows the difference between Temasek and GIC? So what's the difference between Temasek and GIC? Okay, so yeah, okay, yes. Yeah. So Temasek use the money from the CPF, GIC is a fund manager, right? Yeah, you're right. So there are different things. So typically when we see ownership, it's Temasek link kind of entities, not really a GIC link, right? Nobody says GIC, it's more Temasek link kind of thing. GIC is where they are the fund managers managing the reserve of the Singapore government. So I do see also a question about EV versus revenue. Will it be right to use this for relative valuation if you do last week? Um, yes, you can do that. But let's not jump the gun a bit. So relative valuation is a whole lecture altogether. But you're right, right? We can use EV versus divide by revenue, particularly if we see that the EBITDA is negative. Then if you use then use EV divided by revenue makes more sense rather than enterprise value divided by EBITDA. Yeah, GIC is currently diversified. They basically manage a fund, right? It's like your Norwegian wealth fund. They manage a portfolio. Okay, regarding your quantitative aspect, now we move on to providing some forecasts, right? So that's where you kind of project your financial statement and then determine whether the stock is over undervalued, and from there you make a recommendation whether it meets the objective of your investor in your step five as well, right? So four and five can be kind of combined together. Basically, it's almost towards concluding on your report. So there's an important point to make here, right? Making a recommendation. So in your assignments, in any valuation report, right? It's a report which should have a conclusion at the end. And this conclusion means that you must make a recommendation, right? You cannot be doing all the steps, the qualitative, you do a quantitative, you do a very fancy model, and then at the end, there's no recommendation. It's like, oh, okay, it's the stock price is $50. But what does this mean? Is it overvalued? Is it undervalued? Can we do some peer comparison? So what's not mentioned here is yes, we need to do some kind of comparison, kind of benchmarking, right? To kind of determine, okay, is this stock that I want to recommend that you should buy because it's undervalued, right? So this part is important. So when you do a valuation report, do always remember that you have to conclude, make some form of conclusion. And typically in your assignments, a conclusion can be easily 5 to 8 marks, right? So in case, or sometimes I see reports where they forget to conclude, it's very unfortunate, right? So you just lose the 5 to 8 marks immediately. So do be very careful and make sure that you form an opinion at the end to conclude based on the analysis that you have done. Right. Okay. Not really go through. not really go through this. This is basically what's fundamental analysis. We talked about this already. So in doing the analysis, right, in doing the valuation, what we're trying to do here is we're trying to determine whether a stock is under or overvalued, right? When something is undervalued, that's where there's a good opportunity to buy because it's below the value of the market. And so it's a good time to buy and hold this stock. In your valuation, we need to consider both the numerator and the denominator, right? So when we do your forecasting of, let's say, cash flow, your profitability, etc., that is on the numerator, right? You're forecasting the cash flows, you're forecasting the income that the company is going to make. So that's the top, the numerator. Now, it's not as important to forecast the discount rate, right? So the discount rate has to be, risk adjusted. We'll talk about it in detail in the next few lectures, but we need to determine or you know how to determine the right discount rate to use. So both the numerator and denominator plays an important role in your valuation. No. So if your market cap is higher than equity of the company, is it overvalued? No. Okay, so how you think about this, right? So when you think about equity, right? So equity is the book value, right? So typically your market cap would be larger than your equity of the company, right? So how you think about this? When a company issues share, this share price at the point of issuance, let's say the share price is $1 per share, is recorded as equity in your company's balance sheet. So it's $1. But you know that the company share price will generally fluctuate, right? Uh, and it will never ever be always $1, or at least for a normal growing company, you'll always be going upwards, right? So at that point of time, it means that the company's share price can be $2, 2.50, and over the next 100 years, right? Generally, the trajectory is supposed to be upwards. So if that's the case, then the market cap of the company will always be larger than equity, book value of equity of the company. And so using this comparison will always give you an overvalued stock. But that's not the case, right? It doesn't make sense that all the companies are overvalued. So no, comparing the market value and book value equity is not a good way. And so this is one of the relative valuation comments that we will talk about in I think lecture 3 or 4, right? When we do relative valuation. Very good question. Okay, top down or bottom up? So top-down approach. Top-down approach basically starts off with this, right? We have a economy, we have we kind of determine, okay, which economy is doing well, is in Asia, right? And then from there we kind of narrow in, right? Okay, so which sector in Asia is doing well, and then we determine which company in this sector is doing well, and that's where we do the analysis of this company, and then we make a recommendation, right? So really going from the top layer, really going down. Now, there is this other approach called the bottom up, where we start off with a company in mind already, right? So in this case, we already determine, okay, we want to invest in this company, and this is your suspect company. And from there, we kind of, if we just look at industry and economy, it doesn't really benefit our analysis so much because we have selected a company, right? So the analysis is not that important, but then at the end of the day, we can use the sector or industry to kind of substantiate a bit of why invest in a company. And so that's kind of more the bottom-up approach of analyzing a company. But what I'd like to highlight to you is that most valuation doesn't take the form of top-down or bottom-up only. It's normally a mix between both, right? So what does this mean? It means that we already have an idea of what the company is that we want to value or we want to invest. having this idea already, then what we do is that we look into the market research, the sector research. We dive deep into the industry analysis to see that, to test that actually this company is robust, is strong in its sector, is the best company to invest in this current state of the economy, right? We kind of do a bit of, kind of reverse engineer, right? Because we already select the company. Now, if the market research, if the industry analysis prove us right, then we go deeper to do the analysis of the company, and then we make a recommendation, right? So we see that in this aspect, there's a bit of overlap between top down and bottom up. So what I'm trying to explain to you here is that it's never one or the other. Normally, it's always a combination. Questions? Right. So lecture one, we're going to cover this component, and the rest of the lecture is all your quantitative models. All right. Okay, so before we start off on economic analysis, let's take a short break. Maybe we come back around 8:15 before we move on. Just a one reminder for you to form your GBA groups, and feel free to drop me an email, right? Once you form your groups, you can take the break to discuss on the chat. Feel free to do so. Right? I'll see you back at 8:15. All right. Welcome back. So we have a good break. I do see some people looking for GBA groups. So yeah, feel free to do it on the chat. All right, let's continue. Let's continue on our first economic analysis, right? So the idea of economic analysis is understanding how the economy is functioning. So this is your first step in the valuation aspect of your company, right? And so how we think about economic analysis is that if a company performance follows the up and down of the market, right? Something that follows up and down. They typically are stocks that are higher risk, right? The higher risk premium. So what kind of stocks could this be? So question, if a company's performance follows the trend of the market, the business cycle, they typically have higher risk, right? But what kind of stocks are these companies generally in? What kind of sectors are they generally in? Consumer goods, tech sector, you're right. So something that relates to more discretionary kind of goods, something like technology, you're right. So as compared to companies like in a sector that does not follow the trend or the business cycles ups and downs, right? For example, things like utility does not follow. So or pharma, right? Pharma does not follow, typically does not follow the up and down of the business cycle. So from there, we should proceed on to kind of try and understand, okay, so we know that different stocks react differently in the different parts of the business cycle. Then are we able to forecast certain kind of lead lag kind of relationship or factors that can indicate when the business cycle is going up or when is it going down, right? So this is part of our economic analysis. Now, our most basic way of measuring the economy is GDP, right? So I believe this is not new to I think 99% of you guys. GDP is the simplest measure to determine how much goods and services is being produced in a country in 1 year. So generally, higher GDP is better, right? Higher is better. There could be a GDP gap or output gap where the actual GDP is um, let's say less than expected GDP. And if there are 2 quarters of decline of the GDP, generally we consider this as a recession. So the economic cycle of the country kind of determines how the company perform if they are in particular sector. For example, like what you mentioned, pharma, right? Pharma could be more defensive. Then we know that if a recession is kind of approaching, this company could weather the recession a lot better than a discretionary product kind of company. Things like LVMH, which typically people only buy or spend more when the economy is doing well, right? So when the economy is doing well, we will have higher disposable income, more consumption, more loans, more production. So everything is going up, right? So people are spending more, people are producing more because there's more demand, and the cycle repeats itself. More people are hired, so the cycle repeats itself, right? It builds on and it causes the economy to grow. Now the question is, how do we kind of predict how the economy is going to react or how the economy will be in the future. This is where your leading indicators are. And in the simplest form, right, imagine that we notice the number of hours worked in, let's say, a manufacturing factory has been increasing over time. right? This becomes a leading indicator to tell you that, hey, you know what? Maybe the factory is producing more, right? The people are working longer hours. They are producing more, meaning that when production increase, there must be a higher demand so that the companies are producing to meet this demand, right? So this kind of a leading indicator, right? Average, let's say the average hours work per week. So this is a good leading indicator. Maybe another leading indicator could be new orders. So um, it's quite common for shipping companies. So shipbuilding companies, sorry, not shipping companies. Shipbuilding companies typically announce their new order books. So what's this? So new order books is basically they publish on their annual report to say that, oh, you know what, we have 500 new orders for the next 2 years, right? And because things like uh, shipbuilding takes a long time, right? It takes uh, as long as 3, 4 years or 5 years just to build um, a ship. So the order book kind of provides you information on what is the demand for their products in the next 5 years. And so if the order books are increasing faster than how many ships they can produce, this gives you a leading indicator of how the economy will be evolving in the next 5 years, right? So there are various aspects. It's just two aspects I'd like to highlight to you. And so we can use such information to draft your economic analysis of this particular economy you're trying to assess. Mm. Of course, as any indicators, there could be false signal, there could be variability in the data as well. So, for example, during a black swan event, all of you have went through COVID, so COVID is a black swan event. When such black swan event happens, typically your data changes, right? You are no longer looking at the same economy. You have to rethink what kind of businesses will do well, what businesses will fail in such an economy, right? So data points can change, and because of that, we need to reassess the economy. Uh, and yeah, right. So these are some leading indicators. There are things like coincidental and lagging indicators. However, they're not so critical in doing valuation because typically when we value a company, we want to know what's the future of the company's performance is, right? Which is why we use the leading indicator instead of something that is lagging or coincidental, right? So our focus is really on what's the future of the company. Right. On this point, just want to highlight to you that when you do a valuation of a company, right, do be very careful on which economy you are assessing. So I'll give you a good case in point here. So, um, let's say we go back to the idea or the company of Olam, right? As I mentioned, Olam is a soft airy company, and soft airy company typically buys and sells in areas like the Black Sea region, right? The Black Sea meaning Ukraine, Russia, because they grow a lot of wheat, corn, flour in the area, right? Or the African region, right? Places like not Dominican Republic, sorry, Ghana, right? Gabon, which is where we call the breadbasket of the world is, right? So the Black Sea region and the African continent. Now, the question is, even though Olam is a Singapore company, which region of economic analysis should you focus on? Right? You're right. The regions that it operates in, right? Meaning that either the Black Sea region or African region, and those are the areas you should focus on. Yeah, absolutely right. So when we do economic analysis, right, do not jump straight to the conclusion that okay, this is a Singapore company, this is listed in SGX, and so the economy that we should assess is Singapore. Hope you can see that we need to see where the company is operating in, which is their major market. It could be also where they sell the products, right? Which is their major market. And then you assess the economy of that market, right? Another example I like to give is maple tree. Everyone knows maple tree, not Maple Story, but Maple Tree. Yeah. So Maple Tree. So Maple Tree is a real estate company, right? They do real estate investments, mostly in Asia, I would say. Now, Maple Tree has a very large China portfolio. I believe it's almost more than 50% of their portfolio, investment portfolio is in China, right? Property investment portfolio is in China. Now, even though Maple Tree is a Singapore company, shareholders are all Singaporean, etc., but because their exposure to the investment property market constitutes majority in China, then our analysis of the economy should be the Chinese market, right? And not the Singapore market, not the US market. Not we shouldn't be talking about the US Fed rate or what is the interest rate in Singapore, right? We should really focus on the Chinese market. So I hope you can see that the before even jumping into the economic analysis, we really need to understand the company first, right? Which what's the operations, where are they located, and which geography their main offices, their main businesses are before we jump straight into economic analysis. Okay, hope this tip is useful. Um, and so having done economic analysis from a broad like economy, we kind of focus now into the business, right? In terms of the business cycle of the economy. And we typically know that business cycle lasts between 9 to 11 years. There's going to be ups and downs, ups and downs. And at different point of the business cycle, there's characteristics that kind of dictate how the cycle will continue, correct? Things like inflation, things like interest rates. And we have five key phases of a business cycle to focus on. And so we start off with the initial recovery. So initial recovery is where the economy is starting to recover from its lowest point, right? And so, consumer confidence is still low, business confidence start increasing, unemployment still quite high. So things are still not doing too well, right? Inflation is decreasing. Yes, stock might slowly rise. Bond price, because bond is safe haven kind of trade, is kind of at the highest rate, right? So these are some characteristics of an initial recovery of the market, of the business cycle. Now, then we start going faster and faster, meaning we start going on an upswing, right? The early upswing, where the business starts improving, unemployment starts falling, stock price increase, maybe inflation remains low. And this is where, the short-term rates or the central bank rates still remain low. Now, at the later upswing, that's where people are becoming richer, right? There is more confidence, people have more money, inflation now increase, right? Because there's more money chasing the same amount of goods. So inflation start increasing. At the same time, bond price, no longer is at the highest. People are more interested in stocks. Stock price kind of increase because of higher demand, higher interest in stocks, right? And so after this, we move on to more of the slowdown. Things are declining. And so we see some characteristics like, oh, you know what, inflation now continue to rise. Bond price is at the lowest already. And normally at this point, stock price might start to fall, right? And finally, you reach back to the lowest point, which is the recession, right? 2 quarters of GDP decline, and that's where bonds become the safe haven trade and stock price is highest, right? So understanding which part of the business cycle that economy is in will give you a good idea of how that company would likely perform, right? Or not only the performance, but like what are the characteristics that the company is working with. For example, what is the short-term rate going to be like? What's kind of inflation it will be. And so maybe a question to all of you: where do you think we are in the business cycle at this point of time? Construction, okay. So the slowdown, okay. More slowdown, yeah. Potentially, yes, right? We can argue there's a slowdown. Um, yeah, inflation is lower. So initial recovery for Singapore, yeah. So if you ask me, right, okay, so it seems like many of your think it could be the slowdown. I would actually think maybe initial recovery, but at the same time, this time the market is also a bit messy, right? It could be also the could be also maybe some people might even say recession, or they call it technical recession. Yeah, so it really depends, right? I think this time the market is quite messy, which is why we see a bleed between like slowdown, maybe even a recession or early recovery, right? Somewhere in between. So prices are also quite volatile, which is typical of more recession kind of environment, right? So really debatable. On this point of business cycle, I also want to highlight to you that when we assess a company, do keep in mind on which financial period you are assessing the company, right? So typically, what you are going to assess is FY24 because that is the audited financials that are being released. So do bear in mind that when you do a business cycle economic count analysis, really focus on what 2024 was like, right? Not what 2025 was, because your financial statement is FY24, right? So that's an important consideration to highlight in your analysis. So, for example, if in your analysis you suddenly talk about things like um, tariffs, is that wrong or right? Like the US tariffs. Yeah, right. So it's wrong. So, 24 wasn't the US tariff, right? So US tariff was just last year. So it's wrong. So just be very careful what period are you looking into? Because remember, your economic analysis kind of really substantiate the company's performance or try to bring some context to the performance of the company, right? So when we think about economic analysis and we look at the financial statement, if we are looking at FY24, which is 2024, then maybe we should really be focusing on things like interest rate environment. Because I think 2024, the interest rate was one of the highest, right? Um, and so, and yeah, and there's some geopolitical issues as well. So those are the 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 issues, the business economic issues that we really should be focusing on in 2024. Now, we can talk about the tariffs in our projection for 2025, 2026, 2027, right? Which is what you require to do. So in the projections, you can actually use those more current information, but in your explanation of the historical data or historical financial information, then you cannot use um, information in 2025 and 26. Okay, just be very careful when you look at the time period that you're assessing this economic analysis or business cycle, right? Okay, typically, in a business cycle, consumers play the largest part. They contribute 60-70% of your GDP. Small businesses, not so much. And then foreign trade, depending on how big trade is to the company, or the size of the economy, can represent 15 to 20%, 10 to 15%, or 30 to 50%. Right? So at the end of the day, the consumer plays the biggest role in the economy. When the consumer is confident, when the consumer is spending more, or their salary is increasing, then we see the economy growing as well. Some interesting things to consider. So fiscal policy and monetary policy, right? So fiscal policy is about cutting rates, increasing spending, right? So these are just a bit more touch and go kind of concepts that I hope all of you can kind of incorporate in your valuation. So we know that there is a push towards cutting rates since last year, right? That's why rates has been going down in 2025. The peak was 24, 25 has been going down. And the idea is that 26 rates are going to go down as well, right? Because of fiscal kind of policies that's being placed. So by articulating such policies, you can kind of provide you a roadmap in terms of how your discount rate will change over time, right? So in order to really value a company accurately, we need to be careful of what discount rate you use, right? It is not correct to just use a flat discount rate of, I don't know, 8% every year, right? And then the question is, if you are operating in Africa region, right? If the company is operating Africa region, maybe the discount rate you should use in Africa, you should use the African discount rate, which is actually quite high. I think typically African discount rate is like 20%, 25% kind of discount factor, right? Compared to maybe things like in Singapore, discount rate is like 5% or 4% maybe, right? So things like discount rate or things like fiscal policy can actually affect your valuation through the discount rate channel, which is why, kind of explaining the fiscal policy of that country, of that period they're assessing becomes increasingly important. In terms of monetary policy, this is where we look at the interest rate, the money supply. Again, it will be a factor that could influence your analysis of how the company is operating in that environment, in that particular country. We generally have either a stimulative or kind of restrictive measure in monetary policy. I won't really go through everything, so I believe you have taken kind of Economic 101 kind of course, but you can put in basically information or knowledge from your classes about the environment, the monetary policy of the government to really substantiate how the company is performing in that geography. Right? Uh, so government policy always a mix between fiscal and monetary, depending on the business cycle. Government might choose to loosen or tighten the policies. Right? Questions? Any comments? Right. That's very good. Okay, so this is just a kind of pictorial representation of the different business cycle, contraction, trough, and peak. Right? Contraction, trough, and peak. Now we have talked about the business cycle. We are going even lower now, right? To the sectors. So really depending on which business cycle, then we decide which sector is actually good, right? And there's kind of like a sector rotation that happens, where if we know that we are reaching the trough of the business cycle. What we want to really focus on are more um, capital goods, right? Things that are fixed asset heavy, things that like things like manufacturing and you know that they are resilient, right? Or maybe they are at the contraction stage, not at the right at the bottom yet. Then we want to focus things on like food products, right? Sing pharmaceutical kind of companies, which are more defensive in nature compared to things like discretionary consumer durables kind of sector or companies, right? So really depending on which stage of the business cycle, we can kind of determine which type of companies will be doing well and how you can frame this argument. It could be like, okay, you know what? Now we are at the let's say contraction stage of the business cycle, and we can't anticipate the business cycle to reach the bottom, right? And so because you are anticipating this slow grind to the bottom of the business cycle, therefore you recommend which stock, right? So these are how you can use let's say this sector kind of analysis to substantiate your valuation. Right? So um have anyone taken portfolio management or impact investing and portfolio management kind of courses? Okay, no, no, not yet. Okay, so if you have taken it, but maybe a bit shy, uh, feel free to use those knowledge in portfolio management as well to incorporate it in your valuation report, right? So part of asset rotation is also managing a portfolio. So when you have a portfolio of stocks, um, you rotate your stocks, you buy and sell stocks based on the business cycle, right? So there's a rotation in the sector from maybe more defensive to more aggressive kind of stock. So you can actually use the idea of portfolio management to support your valuation recommendation, right? There are some interesting information. Let you go through this. There are some YouTube videos and Spotify playlists. That's quite interesting, right? So do have a look into them. Now, from sector, we are going even further now. We are going even deeper to the industry, right? What part of the industry is this company in? So we are going even lower now. So we are saying, okay, is this like a startup company? Is this a growth related company? Or maybe this company is in decline already, is no longer popular. This product is no longer popular. So from the sector, we now go into the the industry the company is uh, playing in and which part of the life cycle is the company in. So, as you know, if it's a startup, then chances are your risk will be high, your cost of capital is going to be very high as well, because we know that the product is new. We do not know whether this product would hit the market with a bang or maybe it will just be a flop, right? Revenue might be low, there might not be any profit, the cash flow might be very tight as well. So determining which part of the industry life cycle of this company will be kind of important, right? Then move on to something more of a growth kind of stage where we see that there's increasing demand for your products. But with increasing demand comes increasing competition as well, right? We see increased competition because people see that this business idea is actually working. We want to replicate this business. We want to replicate their products. That's where we see a lot of competition. And having things like patents, maybe you have a niche product. This would help you fend against any competition, right? But if we face with competition, what we could do is also to diversify, to further innovate, right? So looking at their commentaries on their future prospect would be quite important, right? So if we see a company that potentially could be undervalued, then maybe we should also look at what is their growth potential. Are they in the growth stage? Do you see them innovating or diversifying their offerings? Or perhaps you don't. You see them kind of just capitalizing on what they have because they are already in the mature stage of their growth. They already have the product, they have the consumer market share, right? They have a large market share, they are not worried. They are they need not grow more, right? They are comfortable, and many of the companies or blue chip companies in Singapore are like this, right? So things like Singtel, right? Singtel, I think, are very very mature kind of a company that is um not in the growth stage of the say they need to innovate because their market share is being challenged by new entrants. But at the same time, they just have to protect their loyal customers, maybe venture into new markets like in Australia. I think they acquired Opus a couple of years ago. They're trying to capitalize on the growth in Australia. Um, and so yeah, uh, identifying which industry life cycle the chosen company is in would be important to find out where they are or where they will progress further. Last but not least, if the company is in more of a decline stage, that's where will be a bit concerned really, right? So things like SPH. So SPH is your the one that distributes newspaper. We know that SPH hasn't been doing too well. I mean, no, who reads newspaper nowadays, right? Even if they do read it, it's like online. News is all free. It's on YouTube. It's on Facebook. So we know that SPH is on decline. We see that they are trying to pivot as well to things like investment, real estate, kind of things. With, I would say, debatable success. I'm not sure whether they're successful. But yeah, there is a they have to basically reinvent themselves to stay alive, right? There is a need to change what they have been always doing for the last uh 10, 20, 30 years. Industry type. Now, so before that, we are talking about the life cycle, right? Which part of the industry cycle is the company is in? But generally, we have three key industries, right? The company can either be in a growth industry, a defensive, or cyclical kind of industry, and really depending on what kind of products, what kind of offering um, they are providing the consumers, then they fall into those categories. So if you have a new technology, they are generally in the growth industry, things that are more consumer based, food, drugs, utilities are defensive, and the other hand, things are that are discretionary generally becomes cyclical. Okay? So let's say you choose a company um, there's actually an increasing of say a research on nuclear, right? So what's interesting in the market, I think now is that people are looking for alternative sources of electricity. I think even Singapore is also looking into nuclear as a possible source of green energy, right? And so because there's new technology, uh, this thing called SMR, so small medium reactors, where they can actually build small nuclear plants that do not require a large area, which is perfect for Singapore. And by using these small reactors, which is a new kind of new technology, this can actually provide Singapore with electricity clean electricity, more importantly, for the next generation to come, right? Rather than using LNG, which is where Singapore gets almost 100% of our electricity from. So LNG is generally imported versus if we have a small nuclear reactor, we might not even need to import any more LNG to generate electricity, right? So things like this, like nuclear, there are new technologies that we can categorize as a growth industry, particularly in countries like Singapore or even other parts of the world where nuclear is not being used at the moment. Mm, so generally, pharma is considered defensive, uh, but I can see where you're coming from, right? If they constantly invent new drugs, they can be considered uh, growth as well or cyclical. I can see where you're coming from. So um, so weight loss drugs. So this is a more on the US thing. So in Asia, weight loss drugs are not that popular. People don't really talk about weight loss drugs. But in the US, in the Americas, things like Novel Notice, where they have they produce or they research on weight loss, and people actually take these drugs to lose weight. It is uh, a big market there. And so that's why the economic analysis is kind of important, right? Because if we talk about weight loss drugs in Singapore, then you might think of it as uh, not really a growth industry, maybe considered a cyclical kind of industry, or even I would say defensive industry, because people who are taking these weight loss drugs would typically stay on the weight loss drugs. It's not like suddenly there'll be a high demand for weight loss drugs, right? Because the demand is not really there in the first place. It's just a steady kind of demand for such drugs. So it really depends, right? What sector are you in? Which economy you are in? But in the case of the US, whenever there's new clinical research that shows that these weight loss drugs is extremely effective, you will see that stock prices like shoot up the next couple of days, right? So then it becomes very cyclical, or it could be even a growth industry in that sense. Uh, Now, the COVID situation is quite atypical. I'll consider COVID as more of a black swan event, right? So when you think about cyclical industry, it means that there must be ups and downs, right? But I feel that for COVID, it's up because there's a spike in demand, and after that now it's just going down. If, of course, if the pharma company do not reinvent themselves to produce other drugs, right? If they are only going to focus on COVID related drugs, then it's like down all the way. Right? Yeah, Ozempic and GL1, uh, G, GL, GLP-1. So those are two weight loss drugs as well. Yeah, so really depends on what pharma companies. So if most pharma companies they diversify their portfolio, right? Yes, they do have weight loss, they might research in COVID vaccine, but they do have their steady I don't know, diabetes related drugs, heart heart problem related drugs, which are more steady kind of demand products. And therefore we can say that, hey, you know what, maybe they're more defensive in that sense. Okay. Now all banks are focusing on longevity of the tech. I think a lot of banks are also focusing on data centers. Yeah, so the data center build up is very steep. I think a lot of investment is going to data centers because the demand for them in the next 5 to 10 years it's it's exponential because of AI, right? So I think there's a there's a huge demand. So if you're interested to be they call it tech banker, it's quite a good um, sector to go into, right? So tech bankers that are specialized in tech. All right. Okay. So having talked so much about economic analysis and the various kind of frameworks or tools you can use to do your economic analysis, we now move on to more industry-related analysis, right? And have all of you all seen this thing called the Potter's Five Forces before? Yes, yes. Okay, so then we'll not go into so much detail, right? So this Potter Five Forces is a framework for you to determine how or not how, but where can you position your chosen company in the industry, right? Are they a new company, new entrants? Do they have a strong competitive advantage, right? So the Potter's Five Forces really is a very good framework for you to craft and structure your answers. All right. So again, I would like to highlight when we do our qualitative analysis in our valuation, right? I actually strongly encourage you to use at least one, two, or maybe even three various frameworks to frame your answers so that your answers looks more robust. It looks more substantiated instead and and instead of just doing a very broad, very kind of no structure kind of industry economic and all economic analysis, right? So instead of doing something more general, really try to use a framework, bring in a framework to substantiate your answer. And I recall in some semesters that the requirement of scoring full marks for that component is to use a framework, right? So when you draft your paper, when you draft a valuation report, try your best to incorporate a framework into your qualitative analysis. Um, yeah. So for your Porter's five, um, we start off with think the idea of ease of entry and exit, right? So in a situation where a company can enter and exit an industry easily, then there's no barriers to entry. So whenever I think of of entry, my mind goes towards like gen codes. Anyone know what are gen codes or generation companies? So, okay, so gen codes. So gen codes is we call it generation companies in short for gen codes. So what are gen codes? So gen codes are companies that generate electricity in Singapore, right? So we know that Singapore import LNG, but the LNG is just a raw material, right? We still need a power plant to burn the LNG to generate power. Now, there are not many companies that have this license to operate a power plant in Singapore, right? There are a couple of power plants. For example, YTL Power is one of them. Tuas Power is another Genco. So these two companies, among a few others, have the license and have the capital, the capex, right? Have the uh, power generation plant to consume the LNG for them to generate electricity to be sold to SP, right? Singapore Power, all other service or electric providers, and eventually being sold to us. Now, let's say I want to start a Genco company. For me, it will be so difficult, first of all, because I need a lot of capital capex to purchase or to build a power plant to consume the LNG, right? It's not simply just buying LNG. I still have to build a power plant, which means that there's a large capital requirement outlay at the front, and it's going to be super hard for me to enter this market to be a generation company. On the flip side, it'll be very hard for, let's say, YTL Power, which is the existing Genco, to exit because who is going to buy your power plant, right? It's not something that is being sold on the market, right? You can't just say, I want to sell my power plant tomorrow, and then a buyer will just appear on your doorstep to pay, I don't know, you a couple of millions to buy a power plant. No, it's not that easy, right? It involves licensing, it involves a whole lot of legal arrangement. So because of this, it can actually prevent um, company to enter the industry. Now, let's say if we think about government policies, right? So capex is one issue, like Genco capex, that's one barriers to entry. Now, government policy, what's interesting is that if you do choose to analyze companies like Sintel, StarHub, right, many telco companies, it will be very interesting or important to analyze the 5G spectrum that the company is licensed to use. So, and this relates to government policy. Right? So, in the Singapore government, um, in Singapore, the government actually offers this 5G spectrum for bidding every couple of years, right? So the telco companies will have to bid to use the spectrums. Well, because the government built the infrastructure, right? The telco companies use the infrastructure to operate the communication services for us. So what I'm trying to say here is that there is a level of licensing required in order to operate in this sector of a telco. And because of this, it becomes a barrier to entry or even exit, right? Because the license typically lasts five, eight, 5 to 8 years. So I cannot just halfway leave. Maybe I can if I can sell my license to another company, but it's not that easy, right? So these are barriers to entering this market. Okay, the other barriers as well, brand loyalty. Biggest or easiest example is your Apple, right? Apple versus Microsoft, let's say. Rivalry, I would say that generally when there's more competition, prices are being compressed, right? When we see more competition, let's say in the um, telco space, we have like increasingly things like My Republic, Gomo, which comes into the telco space, it kind of compress the prices, good for consumers, but then as a company, maybe not so good because now you cannot charge so much. Right? So number of competition can increase, number of competitors increase competition, things like if your products are homogeneous. So think about things like your night market. So if you go to a night market, when you see things that's being sold in that market, right? Those items are very generic. They're not very special, right? Maybe they are more like uh, daily use stuff, like new clippers, I don't know, sieve, things like household stuff, which are very generic. You can buy anywhere. You don't have to go to the night market to buy. And then because of that, there's a lot of competition. It's easy to replicate. I can just go to my store like down the road instead of going to the night market. So that's one example. Tracks to substitutes. So the best example to think of this is things like sugar versus maple syrup, right? So, like I mentioned earlier, having spent, I think around 2 years in Canada, in fact, in Canada, most people use maple syrup because it's so cheap, right? It's the biggest producer of maple syrup. So it becomes a substitute to sugar. People don't really use sugar that often. Maple syrup is the main go-to sweetener in Canada, right? So then they have some kind of substitutes. And therefore, sugar price might be low because the demand there is quite low for sugar. Another trend to take note can be also the increasing preference for linen. So this synthetic versus cotton and wool. So increasingly, if you go to stores like Zara, H&M, or even things like Uniqlo, right? We see that in the stores, there's more focus on linen products, right? So linen is it's a more natural material compared to cotton, and people increasingly are preferring linen compared to cotton, and so linen becomes a substitute for cotton, like cotton t-shirts, and cotton products, right? So this is a good example of substitutes as well. Last but not least, we can think of cinemas versus streaming. So your Netflix versus your Golden Village thing. Okay, bargaining power of buyers. So this is interesting. Now, when you have one buyer, one giant buyer of your products, it becomes such that you are very dependent on your buyer, right? And when you're very dependent on your buyer has very strong bargaining power. Now, I have a question. When your buyer has strong bargaining power, what will happen to your gross margin? Lower. You're right. Lower drop. Correct. So when we see a shrinkage in the gross margin of your company, and you know that they did not do anything drastic um, in terms of their segments, in terms of their product offering, then maybe you can think of the explanation as perhaps the buyers have increasing bargaining power, right? So I hope you can see that we're trying to bring in some industry analysis into our financial statement analysis now. So bring in some concepts, bring in some frameworks from Porter's Five into your industry analysis. Sorry, into your financial statement analysis. Okay, on the flip side, suppliers who have more bargaining power as well, meaning that you are dependent on one or two suppliers for your products. For example, things like the big five iron ore producer, right? So a big five, not sure whether many of y'all follow the minerals and iron or metal market, but the big five iron ore producers are your companies like Vale, BHP, and um, what's one more? I can't remember the third one, the big three. Let's say Valley and BHP, right? They are suppliers of iron ore, where iron ore is being used to produce steel, right? And steel is typically used for construction, for real estate, etc. So if there are only five giant producers of or a supplier of iron ore, then these suppliers become very big. And it means that small players of let's say, steel refinery would not be able to compete with such large producers, large suppliers of the raw materials. Competitive advantage, just wanted to highlight to you that there are different strategies in terms of the company. Some company really focus on low cost, others might be more differentiated products, or last but not least, more kind of specialized products. So when we think of things like pharma companies, typically if they are producing a very unique kind of drugs, like let's say your COVID vaccine, that is kind of a specialist niche. That maybe not many companies were able to do. I think there was this whole debate about is it the RMA, is it? The RMA kind of structuring of the vaccine versus the traditional structuring. So that technology of RMA is kind of a unique niche specialty that certain pharma companies might have compared to others that might not. And this kind of differentiates their products from the rest and provides them competitive advantage. Right? What's interesting also is that for Porter's Five Forces, we do have various growth in the market size, whether you're in the development, growth, maturity, or decline. At different stages, the forces play a different impact on the company, right? So when it's developing, maybe the rivalry is low, but as you produce, as you go up higher and higher, we see that maybe the rivalry becomes more and more because people start to compete for the products. Maybe the entrance barrier to entry becomes lower. It's easier to replicate, easier to enter the market, right? So there's going to be various levels of um, strengths of the Porter Five Forces. So really determining where we are in the product cycle would kind of direct you to kind of understand how strong certain forces are. Right? So we come up one another framework, Porter's Five. So the PESTA analysis is more, I would say, broad-based, more social related. It covers a wide range of government, economic, social, technological kind of analysis. Typically in the industry, we don't really use these because it's very broad. It's a bit more social sciences, but it's also a good analysis to use if you like to consider more of the social environmental aspect of the industry. Last but not least, SWOT analysis. I just want to make two comments here. SWOT analysis, the strength and weaknesses refers to internal strength and weaknesses, and opportunities and threats are external, right? These are two key differences here. Very commonly used in the industry. I think some of your in your workplace you might use this already. Generally in the industry, people are a bit lazy. Anything that is good enough for point forms, strength, weakness, opportunity, threats. That's good enough for them. They don't want to do the pestle, which is so many other points, right? Okay, so maybe before we go into racial analysis, let's again take a quick, 5 to 7 minutes break. We'll come back maybe around 9:15, 9:17 before we go on company analysis and the last part of the lecture. All right. Welcome back to the last part of this lecture. Um, so so I normally know that the first lecture can be a bit, maybe for some can be a bit dry because it's very qualitative. Um, but yeah, it is again I want to emphasize it's quite important to be able to do the qualitative part of the graduation well. So that's why we two are spending quite a bit of time on this part of the lecture. But don't worry, after this, the next few lectures will involve quantitative really, right? So yeah, I did receive some feedback previously that the first lecture can be a bit dry and qualitative. So yeah, but let's press on. So hope everyone is still doing all right. Okay. Okay. So let's continue. So ratio analysis. So this is the main part of your financial analysis, for our financial statement analysis. And these are just some examples of ratio that you should be using, liquidity, profitability, solvency, turnover, etc., right? Which you can't really expect to know. So I'm not going to go through this. But what I really want to focus on is this component here, which it's something I kind of created as a skeleton of how you can do a very good financial statement analysis. Right. So we start off with what? We start off by looking at the financial statement and we look at the profit and loss and balance sheet. And we try to identify because the financial statement can be so extensive, right? And if you are doing a listed company, it's going to be quite long. So the question is, what do you look at, right? What should we focus on? So the first step is really to look at balance sheet item or P&L item that constitute large portion of that statement. So the sense of balance sheet, then the large statement, large portion of the asset. And from there, then determine, okay, or try to explain why are there some changes across time, right? So really looking at which constitute the largest portion, that's one way to start your analysis. The next one is also maybe focusing on what item has the most drastic change across time, right? Is there a sudden increase in intangibles, right? When there's a sudden increase in intangibles, typically it's because maybe they managed to file a patent, maybe they have acquired a new company where there's goodwill, right? So those are some aspects that could enlarge the intangibles. Then we move on to comparing maybe the type of industry they are in. So earlier we mentioned certain industry, for example, the real estate industry might have a lot of fixed asset because they have a lot of investment properties. And also when you have investment properties, you can have some, I would say recurring items, right? Which might not be common in other industries. So one example for real estate in companies is that they might have a lot of these fair value gains and losses. Anyone know why do they have fair value gains and losses for real estate? Land valuation, yes, potentially so. Or it also can be the real estate valuation, right? Because yes, change in price. Because generally for things like investment properties, they have to market their investment properties based on the market value. Right? Change of valuation, yeah, you're absolutely right. Because of the accounting standards. Yeah, fluctuation in market price. You're right. So yes, so such companies might have fair value gains and losses on a yearly basis. And this is very common. So knowing the type of industry will allow you to determine why there's such changes, and maybe in other kind of industry, these fair value gains and losses might be considered um, non-recurring or one-off exceptional items. But for others, it might be a recurring item like in the real estate business. Hopefully, you can bring in what we have covered on industry analysis and how economic analysis and how this impact the financial statement, like what we mentioned earlier about the bargaining power of the buyers, maybe, or you can mention about some fiscal or monetary policy that could affect the interest rate, it could affect the risk-free rate that you're using as the discount factor. So hopefully you can bring some of those concepts in, and then try to explain in terms of the context meaning the economy at that point of time. Is it a high interest rate environment which will affect their, let's say, interest expense on their P&L statement, right? So those are some ways, hopefully you can see, where we weave in the economic industry analysis with the financial statement analysis to give it more practical explanation rather than just saying, oh, the turnover, where I said inventory turnover has reduced, or maybe the net profit margin has increased. This shows that the company is more profitable. Rather than just saying this statement, try to bring more context, right? Try to bring more life to your analysis to add value to why you are even talking about, let's say, the net profit margin, or why you're talking about the EBITDA margin becoming larger, right? Maybe that's because the bargaining power of the suppliers are slowly deteriorating because of fragmentation of the buyers, something like that, right? So you bring in more context into your explanation of your financials. So I would say this is a very good template when you perform your financial statement analysis, and hopefully you can use this to strengthen the explanation. Okay. Summary, I won't really go through this, but what I just want to say is this. Generally, what we have covered are different frameworks, different tools that you can use for your qualitative analysis, right? Whether you use everything or use some is up to you, but using at least one or two tools will be important to make your assessment robust and makes it and strengthens your analysis. Now, the qualitative analysis is also the easiest to just use AI to do your explanation. And I would say, I'll be honest, and probably those that are working already knows that in the industry, no one really cares whether you use AI 100% or you rephrase everything AI says, right? But because we are in a school, unfortunately, or fortunately, or they force you to ensure that you do not wholesale copy from your AI platform the answers that's provided, right? So at this point, normally I'd like to remind you that because our module is more of a project work kind of a take-home assignment kind of module, the AI score is something that the markers will really look at and could penalize you quite badly if they notice your AI score is very high. You probably already received some notification from the school on this. So just be very cognizant and be careful when you use AI for this kind of academic exercise, right? In the industry, you want to use your copy and paste of AI, nobody's going to care. But because we're in a school, just be very careful because we also want you to try to come up with the ideas yourself, right? Questions? No? Okay. All right. Then we move on to technical analysis. This one I will not really be covering much because we have one entire lecture covering on technical analysis. But basically, what I just want to say about this, right? So what is technical analysis? Basically, in layman terms, technical analysis is looking at the charts, looking at the movement of the prices, and from there determining some pattern, determining some reversal or not reversal, or could be a continuous pattern that is going to happen in the future, and from there predict what is the price movement of that particular stock. And we use this more as a trader, all right? Again, our model is very focusing on fundamental analysis. We do have one entire lecture on technical analysis, but for this first lecture, we're not going to talk much about it, right? So we're looking at some trends, patterns, volume, etc. Again, we're not going to cover this. You can just read through on your own. Something new about this module this semester is that we are actually going to do some calculations to calculate things like moving averages, which in the last few semesters is just about understanding the concept, but this semester we need to know how to do the calculation. So uh, a bit, I wouldn't say tougher, but it pushes you a bit more to really understand this technical analysis. So we'll cover this in one of the lectures. So we're not going to talk much about this. The last part I would like to cover is ESG investing. Again, this is a new component in our module for this semester. So ESG has been increasingly important. In fact, I mentioned earlier, wanted to do my PhD in ESG, or actually did one portion of it in ESG. And so it's something that I'm quite interested in. I think it's quite fun, one of the more fun parts of finance. I would say, fortunately or unfortunately, the thing about ESG in the past, at least, is that it was a good to have, right? It has always been a good to have, although increasingly there's a shift towards it being more mainstream. It becomes a need rather than a want, right? It becomes important aspect in valuation where we see that when there is a focus on ESG, there's an increased ease of funding, increased ease of capital entering the company. So because of this, I think what's interesting to notice about ESG is that we should not just focus on cash flow, right? So I always like to emphasize this. When we think about valuation, do not just think about it as cash flow, the numerator part of valuation, right? Increase cash flow, increase valuation. Remember to also consider the discount rate factor, right? The denominator. So what does this mean? In ESG, right, it means that if there are more funds or more investing companies that would like to invest more in ESG or green stocks or green companies, you're right, you're totally right. The cost of capital is going to be lower. So whenever you think about valuation, right, you must always think about it from a numerator perspective and a denominator perspective. And in this sense, right, ESG in particular can kind of benefit the denominator, right? Notwithstanding that numerator can actually be debatable. The positive impact on the numerator means the cash flow can be quite debatable, and we'll see this in a bit, right? But there's a good chance that your ESG green stock would have a lower cost of capital. Now, so increasingly becomes no longer just a fiduciary kind of duty, it becomes something that it is a must to have for companies. Now, in terms of strategies of choosing which company is good as part of your ESG portfolio, there are four key strategies. The first one is portfolio screening, right? So this is a very, I would say, rustic way of screening your portfolio, where you say that anything relating to a certain category, like fossil fuel, palm oil, you exclude. Anything that is not in this category, you include. However, what happens here is that things that are in the middle becomes included in your portfolio, but they are not that good as well. Okay, I'll give you one example, right? Let's say your portfolio is going to exclude all oil stocks or oil-related stocks, right? So you're not going to include things like Chevron. You're not going to include things like Rio Tinto. No, sorry, Rio Tinto is mining. So things like Chevron, Shell, right? So you want to exclude all the oil stocks. Now, the question is, would you include a stock that a company that does uh, building of ships, right? And the particular company I have in mind is things like Sembcorp Marine. Anyone knows Sembcorp Marine? Will you include this in the portfolio? So Sembcorp Marine or Keppel Marine. Uh, okay, no, that's right. So I see at least 3% say no, but it's not because the ship uses oil. Okay, but no is the right answer. But why? Anyone knows why? So my portfolio is going to exclude any oil stocks because I feel that they are seen stocks. But why shouldn't I include things like Sembcorp Marine? Okay, so maybe this is a bit in depth, but let's try to think about it. So Sembcorp Marine, right? Okay, so not really that they're dependent on oil. Um, what's interesting about this kind of so they are a shipbuilder, right? They build ships, but the type of ships they build are so that these ships can build oil rigs in the sea. So I hope you can see this, right? So it's not because the ships consume oil. I mean, then a cruise ship consume oil, then people shouldn't go on cruise, right? That's not the case. But some of these shipbuilding companies build barges or they build excavators like deep sea excavators to build oil rigs in the middle of the sea, deep sea oil rigs, which then is the one constructing the infrastructure for companies like Shell and Chevron to extract oil from the deep sea, which then defeats the purpose of you excluding oil stocks, right? Then you must include these shipbuilding stocks inside. So what happens with this portfolio screening is that yes, okay, you screen off the immediate oil-related stocks, yes, you remove it off, but at the same time, you might also include lease-back firms like Sembcorp Marine, who does um, shipbuilding, but indirectly contribute to the construction of oil, deep sea oil rigs that drill for oil, right? So I hope this is a good example to show you that portfolio screening is a bit tricky. Um, I did see a comment on ESG as a defense. I like that comment. We'll talk about this in just a bit. Uh, yeah. So I see a question, why must exclude? Because this this example of Sembcorp Marine, they are building barges or excavators, deep sea excavators to assist in building deep sea oil rigs, which is used by Shell and Chevron to extract oil, right? So if you are against any oil stocks, then you should be excluding any oil related uh, support stocks for these major oil companies. Okay. Most welcome. Impact investing. So impact investing is now a way where you pick a company based on its results, right? Based on what it can contribute to the society, to the environment. So you invest in things like sustainable hydrogen power. That's quite debatable, hydrogen now. But let's say wind farms, right? Companies that build wind farms, companies that build solar farms. So those prioritizes their societal benefit because you consume less oil, fossil fuel. But actually, many of these companies are these solar companies in I think nowadays very common in India, Taiwan, even Mongolia, where their societal benefit is very big, right? Oh, it's going to save the world because it is it's green, it's so green and so beautiful, and then we're not going to consume any energy, the whole story, right? But many of these companies are actually in almost a default situation where they have to refinance their debt at insane rate because their return on investment is going to take years, and many of them are not able to push through the period or the high capex that's required upfront. So there is a sacrifice of certain financial rewards, maybe at least in the short term, um, for such companies, right? So it's a bit tricky when we do impact investing. Um, the next way to do is ESG integration, right? So what we do is basically we look at the company's ESG score. And many of you all probably have access to Bloomberg or Refinitiv. And so these paid platforms typically now have some form of ESG scoring. And the thing about this ESG scoring is in terms of investing strategy is that we see, oh, if the score is good, we put it in our portfolio. If it's bad, we don't put it, right? However, the difficulty is that this rating is hardly comparable, right? It's hard to say one score is better than the other because they are all using different yardsticks of measure. In terms of the last strategy, which is active ownership. So what does this mean is if I invest in a company, right? I use my influence in terms of voting rights because I'm a large shareholder to influence the share, influence the direction of the business, maybe even directly engage the management team, the chairman, to focus on certain important topics that is important to me, right? So, there are various examples uh, across the last few years. Anyone heard of the State Street, is it the Fearless Girl, this campaign, the Fearless Girl campaign? So this was a couple of years ago where the Fearless Girl campaign focuses on or gender diversity in State Street. So State Street is one of the largest um, asset managers. So it's a diversity campaign, yeah, right? Uh, that requires their holding companies. So State Street invests in many companies, right? So they require the companies that is owned by State Street or own a certain portion by State Street to respect the diversity requirements that State Street impose on those firms. So these are some ways of active ownership where these funds, these large asset managers impose certain kind of policy and criteria to their holding companies. So this is not just State Street. BlackRock has their own. One period of time it was very popular before Trump and all the throwing out of the diversity chatters out of the with the bath water. That's what they call. Before all of those, it was quite a big thing, right? But now nobody cares about it anymore. Very unfortunate, but something to think about, right? Okay. So then there is this thing called doing well by doing good. So basically, or doing poorly by doing good, doing neutral by doing good. So basically, the idea is that when we invest in ESG, right, do we benefit, do we not benefit, or uh, maybe there's no impact at all, right? When we think about benefit or no impact, we are very, very focusing on the financials, right? So yes, we do good, we build wind farms, but does that mean we are neglecting our profitability or are we taking on excessive leverage, right? So those are some concerns that maybe we are doing poorly because we are doing good. And like what I mentioned about many firms that are investing in wind farms and solar, they're actually doing quite poorly um, when they are doing good, which is very unfortunate, but it's the truth, right? Uh, so many of the times when we think of this kind of ESG investing, there could be some short-term drag for more long-term performance in the future. So depending on the demand, we can have short-term outperformance as well if there's a high demand for it. But then in the short term, maybe not. In the longer term, maybe then you'll see the drag in the financials. right? Uh, there's this thing called reviewed preferences. So investors are increasingly saying that, you know what, it's okay that you don't perform so well. We can understand, we since we are investing in some sustainable kind of company or practices, we can't expect that the return will be lower. Now, I'd like to go back to the point I mentioned about ESG as a defense. So at this point, there's a comment on mitigation, right? So what's interesting is there's a lot of research being done on ESG as a insurance policy. So what's interesting they found out is that some companies does a lot of uh, ESG kind of things like maybe reforestation, right? Or they do beach cleanups, or they support certain campaigns that push for, let's say, reduction in air pollutants being released in the air. So they do all these things, right, as a implicit insurance for them to do bad things or for them to sleep sometimes. So, for example, um, a drug company might support reforestation, might support river cleanups, but maybe occasionally they release toxic chemicals from their manufacturing of drugs into the rivers. And then because they do so much good, it becomes an insurance for them, like how insurance work, right? When there's a negative, you can't compensate. And so what happens, the market do not react so badly and thinks that, oh, you know what, since you do so much good, I will not I will not penalize you so much, right? So increasingly, there's this research, this is whole set of research coming out to show that actually it's true. It works that by doing more ESG related um, campaigns, ESG good, it kind of act as a hedge for the downside negative that could happen. So it becomes an insurance, it becomes a defense, like what your friend was talking about. Um, some motivations. Just want to highlight to you that increasingly it's no longer just kind of check the boxes, a fiduciary duty. There is a level of reputational risks involved, moral considerations. So there are a lot of, today I was just reading a report on NGOs or normally it's NGOs, right? So NGOs would generally write reports on things like deforestation, water pollution. And so there's this report that was published, I think, last year, where they were focusing on deforestation. And in particular, they were focusing on banks that finance companies that does major deforestation in Africa. So was looking into this Olam file, Olam. So Olam unfortunately has a lot of bad press in Africa because their footprint in Africa is very big, right? Olam started as a Nigerian company, which was subsequently acquired by Singaporean investors. So their foothold in Nigeria is very big. And so one of their largest operations is in Gabon. So anyone knows where's Gabon? No, maybe not. Gabon? Okay, no. So Gabon is Western Africa. So Gabon is near to like Ivory Coast. Yeah. So Morocco is at the top, then I like the western side of Africa, Ivory Coast, Gabon. It's a very small sliver of land, right? So what's important is not about Gabon, but what's the story behind it. So what happened is that they have a lot of investment in Gabon. And Gabon, being an African country, unfortunately, governance is not so strong. And so Olam actually does a lot of deforestation in that region to grow things like cocoa, coffee, sugarcane, things like this, right? So that they can trade. And that's how they grow. Now, increasingly, what NGOs are doing is to target banks in order to say, obviously they are trying to target OLAP, right? But they do it through targeting banks to shame the banks to say that okay, X bank, B bank, C bank is supporting OLAP, which is doing so much bad in Gabon. And because of that, banks are very worried, right, of reputational risks, right? Reputational controversies. And so they pull back in terms of financing. And that's how they're trying to protect or how to tackle companies that are in such practices, deforestation or water pollution kind of practices, right? So that's how NGOs are trying to force maybe even companies to be greener, to respect uh, deforestation policies. Okay. Uh, Engagement and divestment, basically, it is either the carrot or the stick, right? You probably have heard of this carrot and the stick. So, do you want the carrot or do you prefer the stick, right? So, the carrot being engagement, right? You are trying to engage you try to improve um, policies, um, your trajectory, right? You're trying to do more ESG stuff, right? Positive ESG thing, or do you prefer the stick where we kind of force you to say, oh, you know what? If you do not come up with a new zero carbon emission policy, we are going to divest your stock. We are going to sell your stock such that the market might be fearful and start dumping your stock in the market and causing your stock price to crash, right? So that is the stake. Or we could coerce together with your minority interests, your minority shareholders, to re-elect your board members, let's just say. So that's more the stake, right? And so those are some ways where shareholders might try to force companies to more greener journey in their growth. Um, we discussed a little about this earlier. Basically, when we think about valuation, the ESG components become increasingly important. And you'll see this in also maybe even your questions that you might receive in your assessments in throughout this course, that there is a increasing focus on ESG and in particular for valuation, how it could reduce your WACC, right? The WACC. Generally, in terms of debt, when you have sustainable debt, meaning green bonds or green loans, they have lower interest rate, which means that you reduce the cost of debt, right? On equity side, there are a set of general investors that only invest in sustainable companies. And so by being sustainable, you typically can attract such investors. And when you have more investors investing in your company, your cost of equity drop. Very good question. I love that question. So as we progress on, so there's this one last slide that we talk about in the future, in just a couple of two slides down. But I'd like to talk about this now since you asked that question, right? What's the trend and transformation? So you do have a good point. What about impact washing? So impact washing can be termed as greenwashing as well. So for those who don't know what it is, it's basically um, saying something is sustainable when it's not sustainable, right? Falsify your ESG. So one of the best example here I like to usually highlight is, oh, I'm a tobacco company, I sell cigarettes, right? And I'm not targeting anyone who smokes. because that's your own choice, right? But let's say I'm a tobacco company. I work for a tobacco company. Um, but we know that tobacco companies, it's bad for the society, right? First of all, if they typically target maybe countries that are lower income, and then people do not really have much disposable income, right? And they're spending on cigarettes, which is a vice that's not really necessary, and they're harming their health, right? So it's like a double whammy. First, they are not really at that level of economic well-being to be buying cigarettes which are expensive, and at the same time they're harming their health, which means that they potentially might not be able to work. There's a long list of negatives, right? Let's just say that. Now, as a tobacco company, I might say, you know what, but I might want to greenwash my negativity by, let's say, oh, I'm actually investing in the slums. I'm pumping in the profits, I don't know how much, 10% of my profits into rebuilding the slum areas in this country, right? That let's say consume a lot of my products. Or I provide scholarships to support students to grade themselves in universities. So some things like this, right, is considered greenwashing simply because you're not actually reducing the effect of your tobacco. You're still going to sell tobacco, right? That's your bread and butter. You need to make money, right? If not, how are you going to support your scholarships, or how are you going to pump money into slums and squatters to improve the conditions? You can't do that without selling the tobacco, which means that whatever you're trying to do is basically just greenwashing to try to provide a nicer image, screening, a nicer kind of like rose-petalled image of your company, uh, still knowing that you're fundamentally not changing your practices, or you cannot change because that is your bread and butter, right? You're selling tobacco, you have to sell tobacco. That's all, right? So this is a very strong case of greenwashing, but I would like to also say that there are many more subtle way greenwashing takes place. And this can be in the form of, as simple as, oh, my annual report, I have my whole annual report in green. And because psychologically, green is very green, right? So if my whole annual report is green, then people think that I'm so sustainable. It can be a very psychological thing, right? Or in my annual report of a, let's say, oil company, I have pictures of trees, or maybe pictures of beautiful rivers and mountains, things like this. It can be more subtle in terms of greenwashing, or it can be very overt, like what they like what example I give you about the tobacco company. Right. So a good question: how can such companies get involved in ESG? I think there is a level of acceptance that as a community we need to understand that there are vices, right, that we all participate in, right? Vices could include things like your typical ones are like drinking alcohol, smoking. Those are vices, right? And we know that a community requires vices. And if there are no vices, people will seek out other vices, right? So then the question is, can we control the spread of such vice? So what the best example is in Singapore is we control where people can smoke, right? Make it so difficult for them to smoke, or they can't smoke while walking, they can't do this, or maybe even drinking, right? You cannot drink past 10:30, you cannot do this. So you make it tough, right? So it's about controlling the spread rather than forcing companies out of it. And so in a similar sense, it's about trying to force them to do more in terms of ESG, but knowing that they have to exist in some form or another. You cannot remove them altogether. It's a very thin line to balance, right? ESG and a scene kind of company, right? Uh, Maybe just I know that we don't have much time. I just want to cover a, a few more things. So in terms of theoretical framework, there is a shift from shareholder theory. So shareholder theory is your most fundamental, in the 90s kind of thing, where the only important person is your shareholders, right? It means about profit, about finance, but increasingly there's a focus on stakeholders, right? We look at the upstream, downstream kind of consumers, or not even consumers, but your suppliers and consumers, and they basically dictate whether you can operate in this environment, right? So it becomes a stakeholder related kind of theory. Now, agency theory, very interesting. What it means is that whenever there's more disclosure, because now instead of just having annual report, we have an ESG report, right? Whenever you have more disclosure, that basically reduces your information asymmetry. And this kind of reduces the gap between your agents, which is your management, and the shareholders, which means it benefits everyone to have more disclosure of ESG, of finance, so that people can make a more, I would say, in-depth kind of analysis and understanding of the company. Last but not least, just want to mention the resource-based view. And what this means is that ESG, it can be a competitive advantage, right? And this is something I hope you can link back to your Porter's 5. So in case you're doing a Porter's 5 or you're trying to talk about um, competitive advantage, try to think if the company has certain ESG related um, competitive advantage in that sector, because it will be a very strong point to drive your industry analysis. Okay. Uh, this one not really going to go through. This is value drivers. Why people are doing ESG, right? And actually that's all I have. So this recap on time value of money is for you to go through, and it's important for you to go through because the next lecture we're going to tackle the quantitative aspect of valuation, and you need to know things like perpetuity, growing perpetuity, annuity, annuity deal, ordinary annuity. So all these concepts, in case these terms are very vague to you, you can't remember 2 years ago, but now you do not know, encourage you to look through them. So all these slides are actually extracted from your level 2 module. Please go through them. But then, yeah, this is at your own time. Okay. But if you do have any questions, do reach out to me. Like I mentioned, I do reply email pretty fast, so you can expect a good reply if you do have a question, right? One more thing I want to highlight is that there's a self-review example for valuation on Raffles Medical Limited. You can have a look at this. It's rather interesting. I think it's a good way to analyze a company. We might not have covered all aspects of this, but you can focus on like more of the qualitative, see business overview, industry analysis of the company. So it is all more a qualitative kind of analysis. The valuation part, we can leave it to lecture 2. And after that, then we can you can go through it. Right? Any question? Do we have any questions? Any comments? Uh, yes. So I would say it's a very good example, but I would like to highlight to you two we can talk here in our tutorial group, which is tutorial group 3. Yeah, so in our tutorial group, you see that there are 2 case study. So these 2 case study actually is written by myself. This Spindex case study is a good example of how you should structure your presentation. So this one uses a SWOT analysis, it's a whole detail on it. So this is a good example, I'd say. So the Raffles Medical one, it's a textbook example, so I wouldn't say it's the best, but this Spindex industry, I would say it's a listed company. It's a quite a good example. It's not too difficult as well. If you do have time, really focus on the financial statement analysis. It goes quite in depth, and this gives you the kind of flavor, the kind of uh, um, I would say the how in depth you have to go in terms of your financial statement analysis. And there's some peer selection as well, which is a good way to have a good reference point. Um, and then you have the second case. So the two cases is also under your self-review. So the index. And then for your Nike case, this is more quantitative, right? So you can put this on the whole first. You can go through this after lecture two, but this one is focused on the quantitative aspect, right? So very important to go through the cases, especially these two, right? So in the meantime, we can go through the index maybe next week since there's no lecture. Uh, Nike we can go through after lecture. All right. Again, last reminder. I know it's a bit late already. It's a Friday as well. I guess it's TGIF. But last reminder, do send me your groupings. Hopefully now or in the next 1 hour. Um, and then once more or less most of you have sent in, I'll release the grouping on our announcement page in our tutorial group. And then do let me know if there are any issues. All right. Okay. Thank you. I just want to thank you for coming for today's lecture. I know it's Friday. Hope you have a good rest during the weekend. Um, I'll probably see you in 2 weeks. Thank you. Thank you. Have a good night.